Stocks continued their tax cut bill surge today with another second consecutive strong bullish move with a gap up on the S&P 500 with a new all-time closing high on the Russell 2000. So I'm going to talk about whether or not that means we're in for a new multi-month trend, or where does this fit? Where does this move fit within this posture that we're currently in? Break down all the technical indicators pretty extensively today, so it's a little bit longer video. There's a lot of I take a look at a lot of things in comparison to what we've seen before, so make sure you check all that out. I also break down what's driving the price action, and how that's impacting these different asset classes and sectors, with really good bullish side, with our trade idea coming from one of the big bullish sectors today, and how today's trade idea differs than what it would have looked like a few months ago, and how you can trade it differently. So let's go ahead and get started. My name is David Settle. This is my market outlook for today, Monday, December the 18th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button right down there below this video. Also, click that thumbs up icon right next to it. That lets me know that you liked it today, that you want me to do it again tomorrow. One click, easy way to give me feedback there. Also, scroll down further, comment on anything that stood out to you from today's video. Love to hear what you're learning, what light bulb moments you have. Let me know what those are. In the video description, there's a bunch of different links there. Subscribe to my daily email newsletter that I send out in conjunction with these videos by clicking that top link. Also, you can follow me on Twitter for more content in addition to these videos. My handle's at the top of the screen here, at DavidSettle42. You can like and retweet today's Market Outlook tweet. That's always pinned to the top of my timeline. Of course, join the Market Outlook community. There's over 700 of us now. You'll find the group there on Facebook. The address is there. The address is also down in the description below. Click that link. It'll take you right there, and click on Join this group. All right, well, let's take a look at the S&P 500 then with the market forecast indicator first to determine what our expectations are going forward. And so again, strong bullish posture as has been the case with the intermediate line entrenched in the upper reversal zone. The near-term line also has made its way back into the upper reversal zone after 2 days below us. See, would it be 2 days at 2 days below it. Very similar to these 2 days that we had below the near-term line. Now, granted, we've already made a good jump, even more now, with the gap up higher today. Again, a lot of positive tax reform-related sentiment going on here. So still very strongly above the 30-day moving average. I mean, that's a pretty decent move there. The near-term line, though, is still setting up. I mean, it can't really get up to a higher high. So now, unless we get back up into the high 90s, which would kind of nullify a divergence. So again, I'm bringing up this divergence for those who don't know what that is. When your oscillator down here, in this case the blue line, gives you a series of lower highs, the index here, so here's the peak right there on the near-term line, it should also give you a series of lower highs that correspond. In this case, it gives you a series of higher highs. So you'd say, okay, well, if the near-term line says that the market forecast, or the S&P, excuse me, should be right where my cursor is here, then all this extra is fluff according to the divergence, right? According to that particular pattern. And so, now granted, like I said, it's going to be hard not to get a divergence because of how high it got there. But if we get up to the high, mid to high 90s again, even if we don't get up to 99.22 and get up above that, then you're probably going to be able to wipe that divergence out. But as it's being said, that's the setup, and again, any kind of pullback would simply just be down to this 2650 level. But any kind of pullback, I mean, that would be a near-term pullback of 100%, right? Because that's where the last near-term low point is. We haven't had a near-term pullback. I mean, this one got close here. And that's why we had an a weak bearish intermediate posture, because that one did get close. But we haven't had a near-term pullback of 100% in quite a while. But like we said, we expect more near-term volatility as we get towards the end of a bullish intermediate run. In this case, closing in on 4 months of a bullish intermediate run. Again, very similar to what we had here, where the fourth month was this kind of great February. We were already 3 months into it by the time we started February. And then we had, which is the expectation. Intermediate runs, bullish intermediate runs, typically last 1 to 3 months, depending upon where the market sentiment is at the time. So that was a fourth month. Here we are again with the market sentiment declining into that fourth month. Here we are again, fourth month with market sentiment declining. And I've been asked about the seasonality of December. Seasonality is bullish heading into the end of the year. So seasonality, the expectations are will continue to be higher according to seasonality. Just don't expect it to be, this kind of a move higher. Now granted, we're continuing to get some pretty strong moves, and we're getting those strong moves based off these tax reform, tax cut bill expectations. But once that bill gets passed, there won't be any more expectations, and the market buys expectations and sells a reality. So we'll see if the actual passing of the bill is what sparks not a bear market, but more near-term volatility, where the near-term line, again, I don't expect the near-term line. It's been about 50 now, 1 day. The typical near-term run is 7 to 12 days above 50. But again, because we've been bullish for so long, I don't expect it to be another 7 to 12 days. I expect it to be a few days, like it was this time here in December, and potentially bringing us back down to that divergent low point at 2650. That would not be a bad thing, nor would it be very bearish. But it would be indicative of the fact that the trend, the intermediate trend, is very mature, and for that matter, market sentiment also is very overbought and very mature, and it's hard to start new multi-month moves from these levels. It's much easier to start multi-month moves when you have the intermediate line down here and market sentiment, and that in this case at least, it was only at 70. This move was only expected to be about 1, maybe 2 months. So the fact that we're getting 4 just shows how it's all been based on these expectations of fiscal policy accommodation. So remember how QE was needed because we were in a recession, right? We were in recession. We were coming out of recession. It was hard coming out of that recession. So we needed accommodation from somewhere, and we weren't getting any accommodation from the fiscal end of things. So it was mainly coming from monetary, and that's why we had, they dropped rates, and when that ran out, they started buying treasuries, and they got to the point where they were buying indefinite amounts of treasuries. The ECB and Bank of Japan are still doing that. So obviously we're tapering a little bit now of those purchases, but that's why the Fed did what it did, because there wasn't any other accommodation coming from the fiscal side of things. Now we're starting to get similar fiscal accommodation that we got compared to the monetary accommodation coming out of the recession. The difference is the market's a lot more bullish than it's ever been compared to when we were coming out, when QE1 and QE2. QE1 came out like in 2008 at the end of when it was really hitting the fan. QE2 came out in 2010. QE3 came out in 2012. So back then the markets were coming up off of lows, weren't nearly as bullish as they are now. But despite that fact, we're getting fiscal accommodation on par with the monetary accommodation. Maybe not QE3, because that was like scorched the earth accommodation. This is probably more on par with like QE2. QE1 also was just huge amounts. QE2 was kind of in the middle, and that's similar to what we're getting here. And keep in mind too, around the beginning of the year, we have another fiscal accommodation policy expected to come out with the infrastructure spending bill that's expected to be debated and brought up at the beginning of the year after the tax cut bill gets through. So, we've had healthcare reform, which is trying to help with healthcare costs. That nothing came out of that. Now we have the tax cut. There's some accommodation, and then the infrastructure. So you can see why we saw how the market responded to all that monetary accommodation, and we would base our expectations on this fiscal accommodation based on that market reaction going forward into 2018. We'll take a quick look at the other indexes here, and we'll take a look first at the Dow Jones, which looks very similar to the S&P, a little bit of a long upper shadow. That's why we didn't get the cluster. I tweeted out today this bearish cluster, alert, but of course, closing prices matter a lot more than intraday prices. But it was kind of a little bit of an alert. And you can see here we're not getting a cluster either because we pulled off of the high of the day. If we take a look at the NASDAQ Composite, we did get a bearish cluster, so we did get all three lines closing up above, which again means we're overbought. It doesn't mean that we have to start moving lower, but it does mean that we're overbought. And the more we get those clusters later in this cycle, in this case for potentially at least 3.5 months, the more we get these clusters up here, and when they include market sentiment in that cluster, then that means that we're that much more overbought. I'm not too worried about clusters when they occur right here. See, the intermediate line crosses above 50. Like here was a cluster in July. Now, it didn't last very long because market sentiment was dropping when this intermediate line rallied. But you get the idea. Like, when the intermediate line is just barely crossing above 50, when we're only a couple of weeks in, we get a cluster. In fact, that usually means that we're breaking through a high point. That's what happened right here. We had to break through that old high point. Didn't last, but that's why you had the cluster. So I'm not too worried about clusters right after crossing the green line crossing above 50. I'm more worried about clusters as we get more than 3 months away from that crossing, like we are right now on the NASDAQ. So, and just another sign that that we're really pushing high here. The Russell 2000, you can see obviously small cap stocks benefit the most from this tax cut, and so you can see it's now closing at where it wasn't even close to an all-time high before. Now it is. Now it did not an all-time high on an intraday basis, but an all-time closing high for the Russell 2000. Brought the intermediate line back up. Now it's back to a bullish posture, and pretty decently, not too strong because it's not in the reversal zone yet, but at least it's above it 50. And remember, it got above 50 over here, so it kind of shows how important it is to stay above 50. And market sentiment's at 75, so it's already still pretty high. So not looking for new strong trend out of the Russell 2000, but a good bullish close nonetheless. Not a close up above the high of that long upper shadow. I've always talked about that long upper shadows. When you had a good bullish move, can act at the top of those, can act as resistance, and we're still within that range. Even though we've closed with a new all-time high, we're still in that range of that long upper shadow there. The long-term trend continues to be strongly bullish, and again, taking a look at the price now, the 50-day moving average continues to be high above. In fact, here, if you recall, we looked at this before, I believe on Friday, that when you compare the MACD, which right now is at 129.91, 129.91, and we'll compare that to current levels at 26.90. We're at almost 5%. Now remember, back here, when the market when it was the most bullish at the beginning of 2014, when QE3 started to taper, it didn't finish till right here. That's when the QE3 ended. So you can see when the momentum, long-term momentum, was the strongest point, was at the beginning of 2014. The market still rallied for a year and a half before it really started to show some long-term volatility, not just short-term, but like big percentage drops, relatively speaking, right? Because we just don't get those anymore. So, and that was like 5.5%, if I recall correctly, from Friday. So we're not even at 5% yet. So that looks more bullish than it was back here. But again, here, let's pull it up. It would be the level there was 104.25, 104.26. And the price level of the S&P at the time was 1842.37. So yeah, just over 5.5%. That's how high it was back then. So very strong momentum, and while it looks like we're getting strong momentum right now, we're not even close. Not even close to that. Well, I guess we're close, but we're not there. That looks a lot more bullish than we've ever been in the last so many years. But the reality is, we were that bullish over here in 2014, and in fact, even in 2013, here when it got up to what, 98.7 at 1649.60, 98. I'm sorry, I have a bad memory. 0.78, 98.78, and that was divided by 1649.60. See, there was 6% at this peak right here in 2013. Right when we started QE3. See, QE3, this is kind of basically where we're at right now, where you've got the fiscal policy, version of the monetary policy accommodation that we had here. And you can see it really got bullish, and we even got really pretty bullish here in 2011 coming off of QE2, right? So QE2 pushed us up, to 89.69, 89.70. And that was when we were at 89.70. We were at 1343.01. So look at that. We were 6 2/3. So that was the most bullish we've been during this rally in terms of long-term momentum. The most bullish. Then we had right here. So that was 6 2/3. This was over 6% when we started QE3. Then, as we started to taper, right before we started to taper, that last QE3 push at the end of the year seasonality, we got up to over 5.5% of current levels. And now, as bullish as this looks on an absolute basis, on a relative basis, we're not even at 5% of the S&P yet. So it's always, best to compare these to averages, and you can see, and it'd be nice if we could build an indicator where we can show the MACD as a percentage of the current price, because that's what matters the most, right? That's, this is just an absolute value of the gap between these two lines, the 50 and 200-day moving averages. But those two lines get bigger and bigger, so that gap, is bigger or smaller, relatively speaking, based on where those actual levels are. And those actual levels just keep going up and up and up and up because of inflation, for one reason. That's just how stock market works over the long term, at least, and over the short term lately, it seems like. So that's what the long term chart's looking at. And you look at the 3 green arrows. We still have 3 green arrows are still way up above the 8-day moving average. And again, that's that is pretty high up above the 8-day moving average. You look at the MACD here for current price compared to the 8-day moving average, and we're pretty far up above there we go, 25 points. It's not very often we get this high, and that's the absolute basis, right? And then you take a look at how far up above we are above the 30-day moving average here, and you can see, again, higher than we were here, and the highest since this March 1st time frame over here. That's how far above the 30 we are. So very, very strong push. Doesn't mean we can't keep going up higher. It just means as you get up to these high levels, expect more near-term volatility. So especially when we're 4 months along, just like we were over here, we were 4 months along in an intermediate trend. We're experiencing a similar phenomenon right now. So you can also see, too, this divergence that's setting up here on the stochastics indicator, and the low point of that divergence from earlier this month sitting right now at the 23% Fibonacci retracement of this intermediate run. So here's the intermediate run that we're currently on, just to kind of show the extent and how bullish we are at this point. So it started back there on, when was that, mid-August. We're closing now. Look at this, the second number from the left. So we have more than 11.25% gain in the past 119 days. So 119 days. Where is it? 119 days. So we have what? 365 divided by 12. So 119 days. Divided by that. So we're almost 4 months, right? 3.9 months. Here. So in that 3.9 month period, we got a 30, look at the second number from the right now at the top over here. So that one right there. 39% annualized return. Annualized. So if you took this and pushed it out. So that's a pretty decent return over a 4 month period, essentially. I mean, 11.25% is a good return over a year. Much less, 4 months, and so less than 4 months. So 38%, that's a really good annualized return. So this kind of shows just how bullish we've been. And a pullback to the 23% Fibonacci level again would just basically get us back eventually, by the time it got there, to the 6-week moving average. It would break us through the 8, obviously, break us through the 17, but it'd get us to that 30-day moving average. And for that matter, it would also get us to, what would it be? Was it 26, just over 2,600, so 26.29, 26 and a quarter. And I mean, that it would get us basically to right about where that 50-day moving average is. But still, I mean, still not even sniffing the 200 days. So that's why I don't want you to think any kind of pullback there would be bear market material. The intraday chart shows the gap. It also shows that dividend. Remember how the dividend? Remember how we didn't get up to new highs on SPY because of the dividend? We gapped down on because of the dividend. Well, now that you account for the dividend, we actually gapped up like all the other indexes. We did get up to a new high. So higher high, higher low, and then now you can see obviously much higher high, more than 1.5 points higher. In fact, we closed here at 266.5. The high was at above 268.50, so a 2-point range today when you account for the gap. And then if you look at the volume here, volume 83 million. And remember, the volume yesterday or Friday was very strong, breaking us through there. And then, so it doesn't look like much of a range today, but you have to account for the gap too. So it's a 2-point gap with 83 million shares traded. 2 points is again off the chart, so not good to be above the average. Better to be below the average to stay bullish. 83 millions, just a little bit below that average. So, you know, again, we want to be down here with the volume and down here with the ranges. The more days you get like that, yes, they're boring and doesn't seem like there's a lot you can do, but that's what sustains bullish moves when you've had this kind of increase in near-term volatility. You take a look at the VIX and you think, okay, well, you know, if those numbers are higher, what's interesting is you can see this has come up from the end of November. This has come, or really from the middle of October. You can see how the volume has gotten bigger, the trading range has gotten bigger, but you look from the volatility aspect from the middle of October, so right here, volatility is not, the VIX has not gotten bigger. It's actually lower than we were in the middle of October, where, you know, we were below this red line there. And you look at it on a relative basis here, right here, and again, you can see middle of October on a relative basis, we're lower than that, and we're extreme low. So it seems like things are picking up in terms of short-term volatility, but when you look at the VIX, nobody's really scared about this pickup in volatility yet. So there's a divergence there, and you'd expect at some point in time this volatility to rise to catch up with what we're seeing in this with this volatility, and that will lead to, it will seem more we'll see more volatile because the VIX is higher, but it won't be that volatile because, again, you have to put the VIX in context, right? You know, getting up to 12 and 13, or even up to 15, you know, 15, 16 will seem like it's a big deal, but in context, it will not be that big of a deal. In fact, again, you know, here's the month for December, and you can see kind of the range that we've had. In fact, let's actually look at it this way. Well, whoops. No, we don't want to do that. I need to move my recorder out of the way. Let's look at it over here on this chart, and we'll pull up VIX and look at a monthly chart, but on an expiration cycle. So we'll come over here to 10 years, and we'll look at options expiration. So it's a monthly chart, but the beginning and the end is the options expiration. So we just ended, right? We just ended one cycle, the December options. And the range, you look at the R right up here. So it's right up here on the left. The R is 6 points. That's a pretty decent range. It was 5.5 there. That one was a smaller one. And again, that small range of 2.5 points is what precipitated, you know, a little bit of increase in volatility since the middle of October. Well, now we're at, you know, what, a half, you know, the range obviously is about 0.5 point because we just barely started today. So a 6 point, we're not going to get 6 points to the downside, most likely. 99% chance we won't get that. So if you're looking for a 3, 4, 5 point range, it's going to be again back up to the upside and again up to testing that 15 level. So it will seem like a big deal at the time, but in context will not be that big of a deal at all. If we get up to 20, that will be a bigger deal because we haven't been to 20 all year, right? So if we get up to 25, we haven't been up to 25 since we tested that late 2015, early 2016 lows when the 15 200-day moving average was basically sitting on top of each other. We're not anywhere near that point, so we don't expect that. But we do expect, you know, a move up to 15 move up maybe up to 16 in that area during any kind of pullback here. And again, look at it as another buying opportunity if and when it happens. All right, so here's the impact of the tax reform. You can see that stocks did really well. Interestingly enough, international stocks did really well today, better than the S&P 500. But keep in mind, the S&P 500 had been doing the best out of all these stock indexes. Through the last couple of weeks, heading into yesterday, you can see it was way outpacing these international stocks and especially small caps. Small caps was way lagging behind the other equities. So obviously, since then, that's a different story, right? Last couple of days, it's been a small cap move, with large caps coming in about almost half of what small caps have been getting, and both of them above. But again, they were lagging behind there, and then they bounced today. So whereas treasuries have been the worst performer over the last couple of days, and energy is not really going anywhere. And the dollar's flat with high yield. So, but gold, interestingly enough, gold did well today, holding its value with a little bit of a small drop in the dollar. Now, keep in mind, again, gold, any bounces, don't put a whole lot of stock into, any bounces. Let's go to a 1 year chart. There we go. Because right now, we're bouncing up to a potentially lower high point that's currently below previous lows. So, and also below the exponential moving average of this Bollinger Band that we're downtrending below. So that's why I don't put a lot of stock into bounces there. Same thing with crude oil. If you take a look at crude oil, we're kind of going sideways and the bands are really tightening up. So expect a move to come out of this one way or the other. The trend's been bullish, so if you had to put higher odds one way or the other, it'd be to the upside, just simply because of the trend. But the Bollinger Band width is low as it's been. So last time we were this low, we had to break out to the downside. And we had some, lower highs and lower lows for a period of time. Since then, we've been going higher highs and higher lows, and so we'd expect a breakout to the upside here. Again, simply just considering the trend. We go back to here. Go back to what's driving this action today. I did want to show that the main thing that came out of the calendar was simply the housing market index, but it's really the tax reform. I mean, that Friday night, the new version came out. Everyone's voting for it. At least they're saying they will vote for it. So it's widely expected it's going to get passed, and that's what the market priced in today. And you can see even the Fed funds futures market priced that in today, because now you have the odds of a rate hike in March back up to over 60%. So it had dropped over the last couple of days, right back up to 60%. The odds of no hike obviously is down to 40%. Then we look, say, okay, well, what about 2 hikes? What are the odds of getting a second hike by June? Still, that bounced too, but not as much. So the odds of getting another hike, at least one hike, is still pretty high by next June. About 50 some odd percent, or actually of one hike, it's more than 80%. But now it's looking more probable for March than it is for June. But still, we're getting pretty decent odds that there could be a second one by June. We rallied up. Not as high, not as big of a jump, but definitely a big jump for March. So, again, market's expecting the Fed to start tightening the reins, because we talked about, monetary accommodation, fiscal accommodation. It's best when the market's in recession, the economy's in recession, the market's in a bear market. It's best when you hit that recession from both sides, right? Fiscal and monetary, both hitting that. In this case, the last recession, which was so big, we had fiscal just pounding, boom, 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 and not a whole lot coming from monetary, not a whole lot coming from the fiscal side. Now that the market's doing really well, now you have monetary saying, okay, well, now we're going to start hitting this, boom, 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 boom. But we're about 7 years late in terms of when we really, really needed it the most, right? When the Fed was hitting it hard from its one side. So now the Fed sees that the fiscal is coming in with some hard hitting accommodation, and so the Fed's thinking, okay, well, we're going to have to. I mean, the market's overvalued as it is, but inflation's been damp. But we see, indicators like the housing market index hitting all-time, not all-time highs, but highs for this period, looking really, really strong. And so if that's the case, and if we're hitting this with a lot of accommodation from the other side, then the Fed's going to have this higher need to start reining it in more. Now, are we going to get to the point of hikes every single meeting? Probably not. The market's still looking for these every 3 months, right? March, June, September, December, because there's press conferences then, you get the Fed forecast then. So that's the typical time frame for hikes in the current cycle. The last cycle was every month, right? This cycle, or every 6 weeks. This cycle, it's every 3 months, every time there's a press conference to talk about. And remember, the next press conference will be the first press conference for the new Fed chair. So, that's why, again, another thing that could not bring the market down, but weigh on it, right? The market can still go up with weight, but, there might be a little bit more added weight as these rate hike expectations go up. And, economic indicators are very, very strong right now. And so, again, you're getting a lot of accommodation that's pushing a lot of these sentiment indicators really strong. That's what the housing market is. It's a survey indicator. So you're getting a lot of these survey indicators being very, very strong. And once that translates to actual production and subsequently inflation and wage growth, then that's when you're going to have to really start tightening the reins from the Fed. And that's when you'll start. But again, that doesn't necessarily mean bear market. It just means more weight, and lower expected returns than what we've had coming, to get to this point. We zoom in on what the sectors, how they performed today, and you can see technology, consumer discretionary, energy, materials. Now remember, we talked energy and materials. The more that they outperform, then we know that we're in this mature bull market and that we're heading more towards a bear market. Until those commodity prices start hitting extremes and these stocks really start to just kill everybody, then we're not too worried about a frothy bull market. I mean, yeah, we're frothy. Yeah, we're overvalued. But just because we're overvalued doesn't mean, and that we've been bullish for so long, doesn't mean that we're excessive. The excessiveness comes when those materials, which, again, economic demand will start to push those materials prices higher. When there's economic growth, it's got to be fueled by something, and it's fueled by commodities. And so those prices will start to get higher as economic activity picks up and economic growth expectations pick up. So we'll see that. And, of course, that's really when the Fed starts really picking up with their rate hikes and things. Other than that, you can see technology, discretionary. In fact, you can see the utility stocks really dropping down. They really pulled back. Real estate, consumer staples, healthcare, all your safe haven lagging behind. Energy up today, but over the last couple of days, mainly because of Friday, showing some weakness here, a little bit of a bounce up today. But there's over the last couple of days, Friday and today, because Rubio wasn't going to vote Thursday. That's why we had to drop. Rubio said, yes, I will vote for it Friday. And then by the end of the day is when it came out and everything was fine, right? So these last couple of days have really been the tax bill passing move. And you can see, again, it's been financials. They pulled back some of their gains here today. It's been financials. It's been technology. It's been materials. Those have been your biggest movers over the last couple of days. And, of course, all your safe havens, but especially utilities with the jump up in yields. Utility is struggling by far the most. So one of the stocks in that technology, one of the bellwether stocks in that technology area is Intel. And you can see Intel, I mean, there's a lot of stocks like Akamai, stock that we talked about back here in November when I had this 3 green arrow bounce up. Talked about a long call option. You can see it more than hit its target. It gapped well above the target. I think our target was like at 59. And we were well on our way. By January, it's 59. So by the end of January. So well, more than hit its target, more than double. We go for the 2 to 1 reward to risk ratio. By the time it opened and exceeded the target, it had like 4 or 5 times the risk on that. So a lot of stocks followed suit, Intel being one of them. You can see Intel had 3 green arrows today. If you take a look at like its long-term view, bouncing off its 50-day moving average, still way up above its 200-day moving average. So keep that in mind in terms of how bullish we want to be here on Intel? Like, are we going to make a new trend trade on this, considering that we're so far up above the 200-day moving average and the 50-day moving averages too? Not likely, but still pretty, still opportunity there, because, while we might not get it, we got 3 green arrows, we had a sideways trend, we had 1.5 times the average volume, more than 1.5 times the average volume. So, I mean, that's a decent trend trade. And you can see the market forecast, from a market forecast perspective, it's, the intermediate line's below 50, but you see the market sentiment's not. So, while back here, the intermediate line crossed above 50, and the 50-day was closer to 200, and we crossed up there. The market sentiment was below 50. So we had opportunity for a much longer trend there. We don't have that same opportunity now. So we're looking for a bullish trade. And that's why, I know I get comments of, can we look at more stock trades? Well, here's a stock trade that technically would meet trend trading rules, right? 3 green arrows and a spike in volume. But this could be one of those examples where you do a trend trade and you think, why didn't it work? Because I had 3 green arrows and a spike in volume. Because it's a different scenario here than even what we had maybe, potentially back here, but especially when the intermediate line was coming up there off of this higher low point. It's a much different scenario here. Market sentiment's higher, and again, we're just so far up above that 200-day moving average. So not all trend trade signals are alike. This one's different, and so we can be bullish because it is a bullish signal, but we just can't be as bullish. So if you are going to trend trade, if you want to buy a stock, it meets those rules for buying a stock. For what I've taught for years, it meets those rules. But if you are going to buy the stock, then account for the risk that I brought up. The fact that market sentiment's high and that we're well up above the 200-day moving average. And the way you account for the risk is you trade a smaller position than what you normally do. And position size half of what you normally do. That way, if it doesn't work out, which there's a higher likelihood that it doesn't than say back in here, if it doesn't work out, then you take a smaller loss. And it's not that big of a deal. You won't be so emotionally scarred from a loss because it's smaller than what you normally would go for when you're doing a trade. So now you're like, okay, why didn't that signal work? Not that big of a deal because you had a small position on it. Or you can go for, if you are into options, you can say, okay, well, let's take a look at a different option strategy that's not as bullish as buying stock is. So you can see selling puts is the way to be less bullish. Because if I sell this put here, say at 45.5, just selling the put by itself gives me a 38 delta versus buying 100 shares, which would give me 100 delta. So what that means is, if the stock pulls back $1, instead of losing $100, I'll lose $38. Now, if it goes up $1, I'll only make $38 versus 100. But again, it's the risk that I'm more worried about right now than the potential reward because of the timing, right? Because of the technical, the trend, and everything I just talked about. So I'd much rather control that risk, giving myself less potential upside, so I can get take advantage of and do something that's bullish. But again, either do a smaller stock trade than what you normally position size for, or dial back the delta like we're doing here. So I can sell that put and I can dial back the delta even more by buying the 43.5 put. So now my delta is only 23, the positive 38 because I'm selling that one, minus the, with the negative 15. So I got a 23 delta now. And I'm getting about that 30% return on risk, which gives me a decent probability of success. It puts my break-even level, which I have right there at 45. If I put that on the chart, oops, so slice of the chart, then you can see, okay, there's 45, so it's below this big, strong candle that we had today. So there's where my break-even is. And if I do get down to that point here that I've been teaching you about, then I got that 1-to-1 reward to risk ratio, right? That $47 loss for the $47 gain. No harm done. No harm, no foul. I take a small loss. I can recover from that in one trade. Now remember, you're not doing one trade a month, right? You're doing different trades at this, potentially at the same time in different areas, and you're legging them in. You're building this inventory of options trades. So you only have to overcome that loss with one trade. And we know, okay, if it breaks through that 45 level after making a run up to 46, then we're not as bullish anymore. I'm willing to get out if it breaks down below that and take that 1-to-1 reward to risk ratio that I have a decent odds of getting, versus, 1 to 3 reward to risk ratio now, which obviously is a lot harder to overcome. And that's a theme I've been harping on forever. If you're going to trade this way, there's a reason why I harp on this, because that's the type of mentality you have to gain success from selling premium and selling options. When you're looking for a way to dial back the risk, either position size smaller in a stock trade if that's what you want to do, or use smaller deltas by selling puts instead of, or even buying a call option. But that's even more. If I go for the 50 delta, that's even more than selling a put. Or if I go in the money to get a high probability of hitting my target, it's a 70 delta. So I'm dialing from 100 down to 70, maybe down to 50. I can dial it back even more by dialing back to 38 if I sold that put by itself, or 23 if I do this. So you can see the ranges of bullishness with those deltas, from buying stock to buying in the money calls, which is higher probability, buying at the money calls, which gives me the best reward potential, versus selling a put, which takes some margin requirement, gives me a decent reward, but takes a higher margin requirement, versus doing a put vertical, which gives me the least amount of reward possible, but the highest probability of success possible, and the least risk according to the delta. Whew, so that was a long one today. A summary that the market still remains very bullish, very overbought, could lead to some near-term volatility. Not bear market volatility, but near-term volatility. So I'm breaking that down about, okay, how is that going to happen and where is there going to be some lows? I broke that down in today's video as well. And then we took a look at what's driving this bullishness here. Obviously, it's the tax bill is the big headliner right now. The impact that's having across different asset classes and sectors, and then a way to take advantage of it, and a way to do it in a way that dials back risk, because not all trend trading signals are the same. So whenever the trend trade signal comes at a technical time, when there's more risk associated with it, then there's different ways we can accommodate for that risk. So thanks everybody for watching tonight. Remember to subscribe, like, and comment on the YouTube video down below. Also remember to follow me on Twitter if you haven't already, and to like and retweet today's Market Outlook tweets, always pinned to the top of my timeline. You can find it there. The more you do that, the more you engage with my tweets, the more Twitter will keep pushing that stuff out to you. And if you haven't already, join the Market Outlook community on Facebook with the link down in the description below. Have a great evening, everybody. We'll see you all tomorrow.